This video, I want to highlight the benefits of geographic diversification, the benefit of diversifying your investments, across different countries, across different regions, and even across different continents, as the case may be. So, why geographic diversification is essential for every investor. Maybe you are in Nigeria here, you may choose to invest in the US market, and you may equally, have an opportunity of investing in the European market with the right kind of investment apps. So let's highlight essentially the benefits of geographic diversification. Number one here is risk reduction. Is risk reduction. And so by spreading investment across different regions, geographic diversification lowers the impact of economic downturns or political instability in any single country. And so once your investment are spread out, in many other countries, if your home country happen to face maybe political instability or turmoil, then other countries will be there to sustain your portfolio. And so it helps you to reduce risk generally because you are diversified across different countries with different political climates. Number two is access to global economic opportunities. You have access to opportunities, globally. In other words, it enables investors to benefit from high growth markets, such as emerging economy like Brazil, like China, which may offer greater returns than developed markets. Don't be surprised that emerging markets, tend to perform better than advanced economies because of the fact that they are growing. They are just coming up, and so they offer better opportunities for investors. So you have that particular access to opportunities in emerging economies, in emerging markets, in emerging countries. Number three is currency hedging. Is that particular factor that the currency you hedge against currency fluctuation when it comes to your own domestic currency. So diversifying into assets dominated in different currencies can protect against domestic currency depreciation, and potentially enhance returns through favorable exchange rate movement. For instance, now in Nigeria, the government chose to float our currency, against the dollar. I think it's around 100, 1,005 or thereabout, 1,006, naira. And so if you're invested abroad, you discover that by the time you repatriate your profit back to Nigeria, you become a very wealthy individual. That's why it's good you invest away from, outside your country to benefit from currency, currency hedging, to benefit from the strength of other countries you are invested in, away from your own domestic economy. Number four is sectoral exposure. Sectoral exposure. Different countries dominate specific industries, such as, when you talk about technology, the US comes to mind. The United States, they have that particular technological advantage. When you consider automotive or automobile industry, you talk about Germany. You want to invest in the car industry, you could invest in Germany or maybe in Japan, as the case may be. You could also consider like energy in the Middle East. There's this particular company, is this Saudi Aramco or so. I'm not making a recommendation. I'm not citing an example. I'm not recommending. I'm only citing an example. So when it comes to energy, when it comes to oil, you could invest in the Middle East. Okay, so geographic diversification provides access, to strengths. Some countries are known to be they have the expertise in certain economic sectors. If you want to benefit from that, you could invest in those countries. As I just cited earlier, automobile, you go to Germany, technology, talk about US, then, cheap, goods, you can talk about China, and when it comes to energy, oil, you can consider the Middle Eastern countries. Number five is inflation protection. Inflation protection. And so diversification balances the effects of inflation across regions. For example, while one economy may experience inflation, another might remain stable or maybe passing through a deflationary, phase. Let's say in my country now, Nigeria, we have a kind of high inflation rate. So you may choose to invest in countries where the inflation figure is kind of low. All right, so that will help you to stabilize your portfolio and make your portfolio resistance against the impact of inflation. Please like this video and then subscribe to this channel if you've not done that. That will give me the incentive and the joy and the catalyst and the encouragement to keep on bringing contents of this nature to you. Number 7 is a broader investment option. It provides access to foreign stocks, foreign bonds, and even real estate investment trusts, as well as alternative assets unavailable in your domestic countries. Like in Nigeria here, we don't have hedge funds. you can hardly trade in options, or derivatives, but you can do that. You can do that in the US. So you may choose to invest in the US, and then take advantage of this investment you don't have in your own country. So it's very important you key into what is not available in your country and enjoy the rate of returns you could possibly get away from your domestic economy. Number 8 is growth potential during domestic slowdown. Growth potential during domestic slowdowns. It offers opportunities to invest in regions experiencing economic expansion when the domestic market is kind of stagnant. Sometimes there's the economy moves in phases. At a time when the domestic economy is facing a kind of a stagnation, other countries could be doing very well, could be doing wonders economically. You may choose to invest in those countries. So by so doing, you have a better return at the end of the day, compared to just investing only in your country. As much as possible, try to diversify across regions and also diversify across different currencies and even different economic cycles in other countries. Number 9 is diversification across economic cycles. Different countries and regions experience various or varied economic cycles. So investing globally allows investors to benefit from these differences, avoiding over-reliance on one's domestic market performance. So you diversify away from your country, and that will expose you to countries that are undergoing economic phases that is different from your own, from what is obtainable in your own country. You may be facing stagnation in your country. Other countries could be growing economically, could be at the peak phase. And so you may choose to invest in those countries, and that will give you, an enhanced level of, returns. Number 10 is tax and regulatory advantages. Some countries, offer favorable tax policies, while some other countries do not. If your country's tax policy is not favorable to you, if the tax rate is so high, then you may choose to invest in countries where the tax rate is somewhat favorable. And so once you do that, you discover that the tax rate on your overall portfolio will be minimal. Generally, the less the government takes out of your portfolio, the more the returns you are going to get. And so you try to make use of tax advantages that are obtainable in other countries, in other regions, away from your domestic economy, away from your own country of residence. Please, you would have you will come across videos of this nature in my channel that has to do with investing in the stock market in particular. Please go through them. It will help you a lot in your investment journey. So thank you very much for watching.